Hello everyone, today I will be discussing the Waste Management financial misstatement scandal, one of the largest accounting fraud cases of the 90s. This case is significant because it demonstrates how unethical management decisions, weak corporate governance, and audit failures can lead to serious legal consequences for both the company and its executives. As future accountants, understanding cases like this is important because our profession depends on integrity, transparency, and public trust. The scandal also helped shape future reforms in financial reporting and corporate governance. Waste Management Incorporated was founded in 1968 and quickly became the largest waste disposal company in North America. The company provided residential, commercial, and industrial waste collection services and owned hundreds of landfills and recycling facilities. During the early and mid-1990s, Waste Management was viewed as a successful and profitable company. Investors believed that the company was consistently meeting earnings expectations and its stock remained attractive to shareholders. However, behind the scenes, executives were struggling to maintain the financial performance that Wall Street expected. Instead of honestly reporting declining profits, senior management began manipulating the company's financial statements to make earnings appear stronger than they actually were. This pressure to meet earnings expectations became one of the primary motivations behind the accounting fraud that occurred. The fraud occurred over several years, primarily from 1992 through 1997. In 1998, new management took over the company and began reviewing its accounting practices. During that review, they discovered widespread accounting irregularities. Waste Management announced that it would restate several years of financial statements because earnings had been overstated by approximately $1.7 billion. At the time, this was one of the largest financial statement restatements ever reported. The accounting manipulations had artificially increased reported profits while hiding expenses that should have been recognized under GAAP principles. The SEC later investigated the company and concluded that senior executives had intentionally manipulated accounting estimates and financial reporting to meet earnings targets. The fraud involved several accounting techniques designed to overstate income and understate expenses. One of the most significant methods involved depreciation. Waste Management extended the estimated useful lives of garbage trucks, equipment, and other long-term assets. By claiming these assets would last longer than they realistically would, the company recorded less depreciation expense each year. For example, if a garbage truck should reasonably be depreciated over 5 years, but management instead depreciates it over 10 years, annual depreciation expense is cut roughly in half. Lower expenses result in higher reported profits, even though the company's actual financial condition has not improved. The company also failed to properly record impairment losses when assets lost value. Rather than writing down the assets to their fair value, management kept them on the balance sheet at inflated amounts. Another technique involved improperly capitalizing costs that should have been recorded as current expenses. By recording these costs as assets, Waste Management delayed expense recognition and made current profits appear higher. Finally, the company manipulated estimates related to landfill operations, including closure and environmental costs. Because these estimates require management judgment, they became another opportunity to understate expenses and overstate earnings. Although each adjustment may have appeared relatively small individually, together they created billions of dollars in financial misstatements over several years. Several senior executives played significant roles in the fraud. The company's founder and CEO, Dean Buntrock, was accused by the SEC of directing and approving many of the accounting manipulations. Other members of executive management also participated by approving improper accounting entries and encouraging employees to meet unrealistic earnings targets. Another major participant was Arthur Andersen, which served as Waste Management's independent external auditor. An auditor's responsibility is to provide reasonable assurance that financial statements are free from material misstatement, whether caused by error or fraud. However, Arthur Andersen failed to exercise sufficient professional skepticism. Rather than aggressively questioning management's accounting estimates, the firm accepted many unsupported assumptions and allowed improper accounting practices to continue for years. This failure raised serious questions about auditor independence and professional responsibility. This case involved numerous violations of federal securities laws. Public companies have a legal obligation to prepare financial statements that fairly present their financial position in accordance with GAAP. Investors rely on these reports when making investment decisions. According to the SEC, Waste Management knowingly issued materially false and misleading financial statements. Because the misstatements affected investors' understanding of the company's financial condition, they were considered material. The SEC alleged violations of several provisions of the Securities Exchange Act of 1934, including provisions related to fraudulent financial reporting, maintaining accurate books and records, and internal accounting controls. Executives also signed financial reports that they knew contained inaccurate information, exposing them to significant civil penalties and legal liability. This case demonstrates that financial reporting is not simply an accounting exercise. It is also a legal responsibility with serious consequences when companies intentionally mislead investors. After discovering the fraud, the Securities and Exchange Commission launched a formal investigation. Waste Management restated billions of dollars in earnings, significantly reducing previously reported profits. Several executives settled with the SEC by paying civil penalties, and they were prohibited from serving as officers or directors of public companies for certain periods. Arthur Andersen also reached a settlement with the SEC for its audit failures and paid a substantial monetary penalty. Although the scandal occurred before the collapse of Enron, it contributed to growing concerns about audit quality and the relationship between auditors and their clients. The case reinforced the importance of independent audits and effective regulatory oversight. One of the most important lessons from this case involves the role of auditors. Independent auditors are expected to maintain professional skepticism throughout an audit. This means they should critically evaluate evidence rather than simply accepting management's explanations. Auditors should also assess whether accounting estimates are reasonable, investigate unusual transactions, evaluate internal controls, and obtain sufficient appropriate audit evidence before issuing an opinion. In the Waste Management case, Arthur Andersen identified numerous proposed audit adjustments over several years. However, instead of requiring the company to correct the financial statements, many of those adjustments were not recorded. By allowing management to continue reporting misleading financial information, Arthur Andersen failed to fulfill its professional responsibilities. This case remains an important example in accounting education because it illustrates the consequences of failing to remain independent from management. Another major issue was the company's weak system of corporate governance. Senior management was able to override accounting policies with little resistance. The board of directors did not provide effective oversight, and the company's internal control environment failed to detect or prevent the fraud. A strong system of internal controls should help ensure accurate financial reporting, proper authorization of transactions, and accountability throughout the organization. When management is able to override those controls without challenge, the risk of financial statement fraud increases significantly. This case demonstrates that effective governance requires not only strong accounting systems, but also an ethical organizational culture. The waste management scandal had a lasting impact on the accounting profession. It highlighted weaknesses in corporate governance, financial reporting, and auditor independence that became even more apparent following later scandals such as Enron and WorldCom. These events ultimately contributed to the passage of the Sarbanes-Oxley Act of 2002. Sarbanes-Oxley, also known as SOX, introduced several important reforms, including increased management responsibility for financial reporting, stronger internal control requirements, greater auditor independence, and the creation of the Public Company Accounting Oversight Board, or PCAOB. Today, many auditing standards and ethical requirements exist because cases like waste management demonstrated the need for stronger oversight and accountability. Beyond the legal violations, the scandal also represents a major ethical failure. The AICPA Code of Professional Conduct emphasizes integrity, objectivity, due care, and acting in the public interest. Rather than honestly reporting the company's financial condition, management chose to manipulate accounting estimates in order to meet earnings expectations. The external auditors also failed to uphold their ethical responsibilities by allowing misleading financial statements to continue year after year. This case reminds us that ethical decision-making is just as important as technical accounting knowledge. Even highly skilled professionals can cause significant harm when they prioritize financials over honesty and professional responsibility. In conclusion, the waste management scandal demonstrates how accounting fraud can occur when management pressure, weak corporate governance, and inadequate auditing come together. Executives intentionally manipulated depreciation, asset values, and expense recognition to overstate earnings by approximately $1.7 billion. These actions misled investors, violated federal securities laws, and resulted in significant SEC enforcement actions. For accountants, this case reinforces three important lessons. First, accurate financial reporting is both a legal and ethical obligation. Second, auditors must remain independent and maintain professional skepticism, even when faced with pressure from management. Finally, strong internal controls and an ethical corporate culture are essential for protecting investors and maintaining public confidence in the financial reporting process. Thank you for listening. I hope this presentation has demonstrated why the waste management scandal remains one of the most influential corporate fraud cases in accounting history.